You keep hearing about ES, NQ, and YM, but nobody's actually told you what the difference is, which one moves more, or which one you should actually be trading. Let's fix that right now. All three are index futures, meaning they track the value of a major stock index, but they are NOT the same. They have different tick values, different volatility profiles, and different margin requirements. Let's find your match. First up, ES, the E-mini S and P500. This is the most liquid, most widely traded futures contract in the world. It tracks the S&P 500 index, the benchmark for the entire US stock market. If the US economy moves, the ES moves. One tick in the ES is 0.25 of a point, worth $12.50. One full point is worth $50. The typical daily range is 80 to 120 points, providing stable yet powerful opportunities. With a margin of around $12,000 to $15,000, it's the standard choice for professional liquidity. Next, NQ, the E-mini Nasdaq 100. This tracks the top 100 non-financial tech stocks. Think Apple, Nvidia, and Amazon. It is heavily weighted toward high-growth tech. When tech is moving, NQ is on fire. One tick is also 0.25, but here one full point is only worth $20 per contract, less than ES. But NQ moves way more. The range is 150 to 250 points. The dollar swings are massive. Margin is higher, around 17 to 20,000. It's for the action seekers who love high-tech speed. Finally, YM, the E-mini Dow Jones. It tracks the 30 large-cap stocks like Boeing and JP Morgan. These are the industrial backbone of the economy. It's often a more stable, trending market. Math here is simple. One tick is one full point worth $5. The range is 300 to 500 points. Margin is the lowest, between 8 and 11,000. YM is great for those who prefer a deliberate pace. Now let's talk about the game changer, the micros, MES, MNQ, and MYM. They changed the game for retail traders. Micros are exactly 1/10 the size of the E-minis, meaning 90% less financial risk per contract. The biggest advantage is scaling. With micros, you can buy 10 contracts and take partial profits as the market moves. You can take profit on 5 contracts at your first target and let the rest run. You simply can't do that with one E-mini. The math is easy. MES is $5 a point, MNQ is $2 a point, and MYM is 50 cents. It's perfect for learning. Margin is also 10 times lower. You only need about $1,200 for MES or $800 for MYM. Watch commissions trading 10 micros costs more than one E-mini. Once you reach full size, move up to the E-mini. Micros help you manage your emotions. It's much easier to stay disciplined when a mistake only costs you a few dollars. They are also the best way to test a new strategy. You get real-world data and live fills without the high risk. Scaling up isn't just about the math, it's about the confidence. Micros let you prove your edge with real capital before stepping into the deep end. Risk management is a skill, not a setting. Trading micros for months builds the muscle memory needed to protect your account when things get volatile. Because they are so cheap, you can diversify. You can watch ES, NQ, and YM and pick the best setup across all three. Experienced traders watch for divergences. If ES is making new highs but NQ is lagging, that's a powerful market cue. The micros are not just beginner tools. They are professional instruments that allow you to fine-tune your market engagement with surgical precision. Master the micros first. Prove your strategy, build your discipline, and then the transition to full-size contracts becomes purely mathematical. Recap: ES tracks the S&P 500 at $50 a point. Typical range is 80 to 120 points. Master the micros first. Prove your strategy, build your discipline, and then the transition to full-size contracts becomes purely mathematical. Recap: ES tracks the S&P 500 at $50 a point. Typical range is 80 to 120 points. 3 different instruments, 3 different personalities. Choose the one that fits your tolerance and your schedule. If you're brand new, start with ES or MES. It's the most liquid, most studied, and has the best educational support. If you have some experience and want more action, look at NQ or MNQ. Use the volatility but respect the speed. If your account is smaller, YM and MYM are worth considering. Slower pace, lower cost to stay in the game. Most experienced futures traders watch all 3 simultaneously to get an edge on the total market sentiment. They often move together but diverge at key moments, revealing exactly where the smart money is flowing. So that's your breakdown. 3 markets, 3 personalities, 1 decision. Which one will you choose for your next trade? If this breakdown helped you, subscribe. Every single week we break down these markets in plain English. No jargon, no hype. And for our free weekly recap every Friday, sign up for the newsletter at the link in the description. Context and levels delivered. Next video, we're covering exactly how margin works and why understanding it could save your account. I'm Points and Ticks. See you then.